You have just moved your stop farther away because this trade seems to deserve more room, even though the chart has already invalidated your entry. The position is larger than usual, and price is now accelerating against you. Instead of exiting, you consider adding. The dangerous part is that you may feel unusually calm. 3 profitable trades have made this 4th decision feel supported by evidence when it may actually be supported by memory. Success has quietly changed what you require from the market before taking risk. That is the winning streak trap. Discipline can weaken, while confidence feels completely rational. A recent profit does not improve the next setup, but it can make entering early, chasing price, or ignoring invalidation feel earned. Consider a hypothetical trade. After 3 clean wins, price approaches resistance and prints one strong bullish candle. You buy before the breakout is confirmed, increase the position when it stalls, then move the stop when sellers regain control. Each action creates the next problem. Entering early leaves you exposed to an unconfirmed move. Added size makes the normal pullback feel intolerable. Moving the stop converts a defined risk into an open-ended decision. The market remains uncertain, but your behavior begins treating uncertainty as an inconvenience. The important question is not whether confidence is useful. It is how to detect the precise moment confidence stops, reflecting evidence, and starts rewriting your standards. The first chart isolates the candle where a reasonable setup becomes an overconfident decision, and the single piece of evidence that gets discarded. You can often see the change before you feel it. After several profitable trades, the next position is a little larger. Not large enough to look reckless, but large enough to reveal that something has shifted. The chart may be no clearer. The setup may offer no better odds. The only new information is that you have recently been right. That is how risk expands without a formal decision. Success increases your account balance, but it also changes your sense of what you can afford to lose. A normal position begins to feel timid. The amount that seemed responsible 3 trades ago now feels beneath your current level of confidence. You are no longer asking how much uncertainty the setup contains. You are asking how much your recent performance has earned you the right to risk. Suppose, hypothetically, you normally risk 1 fixed unit on a trade. You win 4 times, then risk 2.5 units on the 5th setup. The 5th trade does not need to be unusually poor to cause damage. It only needs to produce an ordinary loss at the moment your exposure has become extraordinary. One routine outcome can then remove a large part of the progress created by several correct decisions. The market did not create that imbalance. The sequence of your bets created it. This matters because position size does more than change the amount gained or lost. It changes the pressure inside the decision. A trade that would feel manageable at 1 unit can dominate your attention at 2 or 3. Every small fluctuation carries more emotional weight because more of your recent success is now attached to a single outcome. Increased confidence leads to increased exposure. An increased exposure can make calm judgment harder, precisely when calm judgment is most valuable. There is also a subtle difference between having more capital and having more permission. If your account has grown, a measured increase in size may be mathematically reasonable. But a larger account does not automatically justify a sudden change in risk. Planned scaling responds to durable changes in capital. Emotional scaling responds to a short sequence of favorable outcomes. From the outside, both appear as a larger position. Their causes are entirely different. Ask yourself a clean question before the next order. If your account had been flat this morning, would this exact setup receive the same size? Keep the chart, entry, and uncertainty unchanged. Remove only the memory of the recent wins. If the position becomes smaller in that version of the decision, then the market is not determining your exposure. The streak is. This does not mean confidence must be suppressed. Confidence allows you to act when a valid opportunity carries unavoidable uncertainty. But confidence should execute a risk decision, not enlarge it. Once it begins deciding the size of the bet, success is no longer merely the result of prior trades. It has become an unmeasured input in the next one, and position size is only the first place that hidden input appears. Even when exposure remains unchanged, A profitable outcome can alter how you judge the decision that produced it. A profitable trade can leave behind the wrong lesson. While the position is open, you may know the decision was poorly made. Something required by your method was missing, yet you acted anyway. Then price moves in your favor, the trade closes green, and the original discomfort disappears. The result begins to edit the memory of the decision. What felt careless in real time is later described as flexibility. An impulse becomes instinct. A fortunate escape becomes proof that you understood the market better than your method allowed. Nothing about the decision has improved, but the profit has changed the story attached to it. This happens because outcomes are clear while decision quality is harder to observe. Profit appears as a number. Process exists in conditions, judgments, and information available at the moment of action. When the number is positive, it is tempting to use it as final evidence that the conditions were good enough. But the market can pay an unsound decision. It can also charge a sound one. Uncertainty makes both outcomes possible. Imagine a hypothetical trade in which your method requires 3 independent conditions. Only 2 are present, but you take the position because the setup looks close enough. A sudden burst of buying carries price to your target. Financially, the trade succeeded. Logically, the missing condition remains missing. If you classify the trade as proof of good judgment, the accidental reward changes future behavior. The exception is no longer remembered as an exception. It becomes part of your working method without being examined, tested, or deliberately accepted. The next time only 2 conditions appear, hesitation is weaker because memory supplies a profitable example. That is why a profitable mistake can be more instructive and more dangerous than an obvious failure. A losing mistake creates friction. It invites inspection because the cost is visible. A winning mistake removes friction. It encourages repetition because the reward arrives before the weakness is exposed. The central question is not whether the trade made money. The question is whether you would approve the same decision if its outcome was still hidden. To answer honestly, freeze the trade at the moment of commitment. Remove everything that happened afterward. Do not use the rally, the target fill, or the final profit to defend the action. Look only at what was known when the position was opened. Were the required conditions present? Was the action consistent with the method being evaluated? If another trader showed you the same decision without revealing the result, how would you classify it? This separates 2 records that are often confused. One record measures what the market paid. The other measures what you actually did. Both matter, but they answer different questions. Profit describes an outcome. It does not certify the reasoning that preceded it. A sound decision followed by a loss may still deserve to be repeated under comparable conditions. An unsound decision followed by a gain may deserve rejection. Until those cases are separated, the account statement becomes the teacher, and the account statement only reports what happened once. Once a profitable violation is accepted as evidence of skill, the next compromise often appears in a place that seems minor, the amount of confirmation you are willing to wait for before entering. The next compromise often occurs before the market has actually made its decision. Price approaches the level you have been watching, but the required break has not happened. You enter anyway. After several successful trades, waiting for confirmation begins to feel less like discipline and more like unnecessary delay. Confidence changes your relationship with time. You begin to experience anticipation as if it were evidence. Because you expect the move, you feel entitled to act before the market confirms it. The distance between "this may happen" and "this is happening" becomes difficult to see. Consider a hypothetical chart. Price has spent the morning below resistance at 50. Your setup requires a close above 50.2D, followed by evidence that buyers can hold the breakout. The current candle reaches 50.05 and begins to accelerate. You buy there, reasoning that waiting will only produce a worse entry. At first glance, this appears efficient. You are ahead of the crowd and closer to the level, but you have not simply improved the price. You have exchanged information for position. The market has not yet shown that supply above resistance can be absorbed, so your entry depends on prediction rather than confirmation. That exchange changes the trade itself. A confirmed breakout gives you a defined event to evaluate. An early entry places you inside the ordinary noise that occurs before the event. If price slips back to 49.80, nothing may have failed because nothing was confirmed. You are now carrying risk during a phase your setup was designed only to observe. This is why an earlier price is not automatically a better price. A small discount can be expensive when it removes the evidence that justified the trade. You may save a few cents on entry while accepting much greater uncertainty about whether the opportunity exists at all. The deeper issue is not impatience in the usual sense. You may be sitting quietly and watching carefully. The problem is that recent success has made your forecast feel unusually reliable. Once the expected move seems obvious, waiting for the market to verify it can feel almost ceremonial. Yet the market does not owe confirmation to a confident forecast. Direction and timing must therefore be judged separately. You can identify the eventual direction correctly and still enter at a moment when the trade has no structural support. Price may spend an hour moving against you before breaking as expected, or it may never break. In either case, being broadly right about direction does not remove the cost of being prematurely exposed. Before acting, identify the exact market event that changes your role from observer to participant. It should be visible and specific: a close through a level, a completed rejection, or whatever event the setup actually requires. Then ask one narrow question: has that event occurred, or are you entering because you expect it to occur? This question is useful because it removes urgency from the decision. You are not trying to determine whether the entire idea is correct. You are determining whether the market has reached the point at which your method permits participation. Until then, the setup remains a possibility, however persuasive it may look. But once you enter before that point, the missing confirmation creates another problem. When price turns against the position, you must decide whether the original invalidation still governs the trade, or whether being involved has already changed what you are willing to accept. A stop is clear when nothing is at stake. Before entry, you can point to a price and say that below this level, the trade no longer makes sense. But when price reaches that boundary, the level can suddenly appear less precise. What was invalidation from a distance becomes a matter for debate. Consider a hypothetical long position built around support at 72. Before entering, you decide that sustained trading below 71.60 would show that buyers have lost control. Price falls through 71.60 and remains there. Instead of exiting, you decide the level should be judged by the candle close. The candle closes below it, so you decide the session close matters more. A market condition that once required one answer is repeatedly rewritten to postpone that answer. The stop did not move because the market supplied a stronger premise. It moved because the consequence of obeying it became real. After a series of correct calls, this pressure becomes more subtle. You are not only closing a losing position, you are accepting that the market has rejected a judgment made during a period when your judgment felt reliable. Exiting can therefore feel like surrendering more than money. It appears to threaten the meaning of the streak. That is when observation turns into negotiation. You stop asking whether the original reason for holding the trade still exists. You begin asking whether price might recover if given more time. Those are different questions. The first examines the market. The second searches for permission to delay discomfort. Moving an exit also changes the structure of the decision. The original boundary linked the loss to a specific market event. Support failed, momentum broke, or the expected response did not appear. Once that boundary is abandoned, the position remains open without the condition that justified it. The trade is no longer being managed by its premise. It is being managed by your tolerance for further adverse movement. There are legitimate reasons to update a market view. New information can change the meaning of a level. Volatility can expand. A failed move can develop into a different, separately defined setup. But none of those changes becomes valid simply because the position is losing. Revision requires new observable evidence. Pain is not evidence, and hope is not analysis. When you feel the urge to delay an exit, ask what specific fact has appeared since entry. Not what might happen next. Not what happened on a similar chart last month. What has appeared now that makes the original invalidation less meaningful? If you cannot identify a new fact, then the analysis has not changed. Only your willingness to accept its consequence has changed. It also helps to listen to the language used inside the hesitation. Phrases such as, "Give it another candle," "It is only a temporary break," or "The broader idea is still right," often sound analytical because they refer to time and structure. But each phrase must be tied to a condition that existed before the boundary was threatened. If the condition is invented only after price reaches the exit, it is serving the position rather than interpreting the market. The discipline here is not emotional hardness. It is keeping the meaning of invalidation stable while you are under pressure. The market is uncertain, and some exits will be followed by immediate reversals. That possibility does not make the invalidation false. It only means risk control cannot depend on knowing the next price movement. Yet the negotiation rarely begins at the stop itself. Before the exit is delayed, the mind has usually started changing which market facts deserve attention, and which facts can be dismissed. Confidence first changes the questions you ask of the chart. You stop approaching it as an uncertain situation and begin approaching it as a thesis waiting to be approved. The chart may contain the same information as before, but your search through that information becomes one-sided. Suppose, hypothetically, an index opens near the previous day's high. You expect continuation. The first pullback is shallow, and buyers lift price from the opening range. That response supports the long idea, so your analysis begins to settle. Other facts are present. Each push upward travels a shorter distance. Volume fades near the high. Sellers repeatedly appear at the same price. You see these facts, but they do not receive equal weight. The shallow pullback is treated as evidence. The failed advances are treated as noise. Nothing has been hidden from you. The distortion lies in how quickly the search ends. After several correct calls, your first interpretation carries more authority. You remember that recent impressions led to profitable trades, so the current impression feels proven before it has been tested. Once one supporting signal appears, further investigation seems less necessary. Confidence has reduced the perceived value of contradiction. This is not the same as missing information. A trader can look directly at opposing evidence and still fail to use it. The facts are noticed, named, and then explained away. Weak volume becomes temporary hesitation. Repeated rejection becomes healthy consolidation. Every contradiction is translated into language that preserves the preferred idea. The cause and effect chain is quiet. You begin with a directional preference. That preference determines which signal feels important. The favored signal strengthens conviction, and stronger conviction makes opposing evidence appear less relevant. By the end, the analysis feels comprehensive even though it has moved in only one direction. More analysis does not correct this if every question is designed to produce the same answer. You can study several time frames, draw multiple levels, and examine more indicators while still conducting a search for permission. Activity is not objectivity. The quality of the analysis depends on whether the thesis has faced evidence capable of defeating it. Before committing capital, identify the strongest fact currently arguing against the trade. It must be visible now, not a disaster you imagine might occur later. Then describe why that fact does or does not matter without changing its meaning. If repeated rejection is bearish evidence, do not rename it consolidation simply because you prefer the long side. A second question sharpens the test. What would make you pass on this trade before entry? This is different from asking where you would exit after being wrong. The purpose is to determine whether any present evidence still has the power to prevent participation. If no observable fact can make you stand aside, you are no longer evaluating the setup. You are defending a conclusion. The order of thought matters. Observe the supportive fact. Observe the opposing fact. Compare their significance. Only then form the decision. When the conclusion comes first, every later observation is forced to compete with a position your mind has already taken. Balanced evidence does not produce certainty. It produces a cleaner understanding of what remains uncertain. That is enough. The market does not require you to eliminate doubt. It requires you to avoid disguising doubt as confirmation. But even a balanced reading of one chart can fail if you assume the larger environment still behaves as it did during your winning streak. The next question is not which evidence you selected. It is whether the conditions that made your method effective are still present. A winning streak can make a method feel more powerful than it is. Breakouts continue without hesitation. Pullbacks remain controlled. Price reaches its objective quickly enough that the trade never demands much patience. The execution feels clean, and the natural conclusion is that your reading has improved. But sometimes the market is doing most of the work. Every method depends on certain conditions. A breakout approach needs enough participation to carry price beyond established boundaries. A trend method needs movement that persists instead of reversing toward the middle. When those conditions are present, ordinary decisions can produce unusually smooth results. Suppose, hypothetically, the market has spent several weeks trending with expanding daily ranges. Your continuation setup works repeatedly because buyers keep supporting higher prices after each pause. Then daily ranges contract. Breakouts still appear on the chart, but they stop attracting sustained participation. Price crosses the level, hesitates, and returns to the prior range. The setup looks familiar. Its surrounding environment is not. This distinction is easy to miss because the method has not changed. You are using the same pattern, in the same instrument, with the same execution. Repetition, therefore, feels disciplined. Yet consistent action in changed conditions can produce consistently different results. The market is not required to reward a method merely because the method was recently effective. Success makes this harder to recognize because skill and favorable conditions arrive together. You selected the trades, managed the decisions, and received the profits. Your contribution was real. But the market also supplied movement with the exact qualities your approach needed. If you claim the entire result as personal improvement, you may treat a temporary fit as a permanent ability. The implication is important. A streak does not only report how well you traded, it also reports how cooperative the environment was. Until those two influences are separated, recent performance cannot tell you how the same method will behave when volatility, direction, or participation changes. Regime shifts are often visible before they become obvious in the account. Winning trades begin taking longer to develop. Breakouts travel a shorter distance before returning. Pullbacks become deeper. Price spends more time moving through old levels than holding beyond them. No single event proves that conditions have changed, but the character of movement begins to differ from the movement that supported the streak. This is where observation must become comparative. Do not ask only whether the present chart contains the usual pattern. Ask what the market did after that pattern during the profitable period. Did price expand immediately? Did it hold away from the breakout area? Did participation continue after the first impulse? Those behaviors formed the environment in which the method succeeded. Now compare them with current behavior. The purpose is not to predict a regime with certainty. Markets change gradually, and the transition will never announce itself cleanly. The purpose is to notice when your method is asking for one kind of movement while the market is repeatedly producing another. A useful question is, what specific market behavior made the recent wins easier? If the answer is persistent direction, wide ranges, or strong follow-through, then look for those qualities now. If they are absent, the streak may be evidence of past compatibility rather than present advantage. This keeps success in proportion. You can respect good execution without assuming it operates independently of the environment. A trader provides selection and judgment, the market provides opportunity. Profits emerge only when those two conditions meet. And when the market begins providing less opportunity, confidence rarely accepts the shortage quietly. It often responds by changing what you are willing to call a setup. The change often appears as abundance. After a winning streak, charts that once looked ordinary begin to look actionable. You find more candidates before the open, more intraday patterns worth following, and more reasons to stay involved. It seems that your ability to recognize opportunity has improved. What has often improved is your ability to recognize resemblance. A real setup has defining features. A marginal setup shares some of those features, while lacking the conditions that give the pattern its character. When confidence is high, resemblance begins to carry the authority of equivalence. The question shifts from, is this my setup, to, is this close enough to work? Suppose, hypothetically, your method trades the first controlled pullback after a market establishes a strong directional move. During the winning streak, the best trades come from clean trends making fresh highs. A week later, you take a third pullback in a tired move that has stopped advancing. The chart still contains a trend and a pullback, so the trade receives the same label. But the label now covers a different situation. This is how opportunity expands without appearing to change. The broad description remains intact, while the details become negotiable. A strong trend becomes any upward slope. The first pullback becomes any retracement. Fresh momentum becomes recent movement. Each adjustment is small enough to defend, but together they create a category much wider than the one that produced the earlier results. As the category widens, frequency rises, not because the market is producing more of the original opportunity, but because fewer situations are being excluded. The trader experiences this as greater fluency, decisions come faster, charts seem easier to read, and inactivity feels less necessary. Yet the increase in activity is being supplied by lower selectivity. The danger is difficult to detect trade by trade. A marginal setup is not absurd. It usually contains enough familiar structure to make a reasonable argument. That is why standard erosion rarely arrives as one obvious act. It appears as a sequence of defensible exceptions, each only a short distance from the original pattern. Over time, those distances accumulate. The first trade may be missing one defining quality. The next may be missing another. Soon, the method is no longer selecting one repeatable situation. It is collecting loosely related situations under a familiar name. Results become harder to interpret because the trades no longer belong to the same class. To examine this, define the feature that gives the setup its identity. Not every useful detail, and not a long list of preferences. Identify the condition without which the opportunity becomes a different trade. For a first, pullback method, it may be the freshness of the move. For another method, it may be compression at a meaningful level. The exact feature depends on the approach, but its role must be clear. Then, look at the candidate in front of you and ask, what makes this the same setup rather than merely a similar picture? The answer should point to structure, not possibility. Almost any chart can produce a profitable move. The issue is whether this chart belongs to the specific group your decision is meant to address. It is also useful to notice your language. Words such as almost, basically, and close enough reveal that classification is being stretched. They do not prove the trade is wrong. They show that you are crossing from recognition into interpretation, where confidence has more room to redraw the boundary. Selectivity is not inactivity for its own sake. It preserves meaning. If every upward pattern is called a continuation and every pause is called consolidation, the terms stop guiding decisions. A method remains useful only while its categories remain narrow enough to distinguish opportunity from ordinary movement. And once more situations are allowed into the category, a second danger develops quietly. Several acceptable looking trades may enter the account at once, each carrying a different symbol, but depending on the same underlying move. Several positions can create the appearance of several decisions. You may own different symbols, trade different industries, and use separate chart setups. Each position looks acceptable when viewed alone, yet all of them may depend on the same market condition continuing. Suppose, hypothetically, you are long a semiconductor company, long a technology index, and long a manufacturer that supplies the semiconductor industry. The charts are not identical. Each trade has its own entry and its own reasoning, but beneath those differences, all three require continued strength in the same area of the market. You do not have three independent ideas. You have expressed one broad idea 3 times. After a winning streak, duplication can feel like confirmation. The first position begins working, then a related chart breaks higher. A third symbol follows. Because each trade appears separately on the screen, each one seems to provide new evidence that your reading is correct. But related markets often move together, because they are responding to the same flow of capital. This creates a false count. 3 profitable positions may feel like 3 successful judgments when they are 1 judgment carried across 3 instruments. The account shows 3 green numbers, but the source of those profits may be singular. If that common source reverses, the losses can also arrive together. Correlation is often least visible while trades are working. In a steady advance, each chart seems to follow its own pattern. When pressure enters the market, the shared dependency becomes clearer. Traders reduce exposure across a group, an index falls, or one economic change alters the value of several assets at once. Positions that looked separate begin moving as one. This is why portfolio risk cannot be understood by inspecting one trade at a time. Every individual position may be reasonable. Every single loss may appear manageable. The danger emerges from simultaneity. If several trades are vulnerable to the same event, their separate risks can become one concentrated consequence. The common factor is not always industry membership.